Hello everybody, I'm Billy Abrams, President and CEO of ADM Securities and also work for Correspondent Business Development for AD Mortgage. And this is your weekly digest. At the weekly digest, I usually start off by talking about what's happened over the last week. This week was all about the Fed, the FOMC meeting, and what the Fed was going to do. And most of the numbers prior to that, which might have made sense and mattered most weeks, didn't matter so much this week. Wednesday afternoon, the Federal Reserve raised interest rates 75 basis points, exactly what they were expected to do. The statement they released afterwards pretty much looked like the last one. So there were no real surprises from the Fed. They raised rates 75 beeps, and they let us know that at the September meeting, they may have to go that high again. And they would read the data in between now and then. What happened though after that was the very next morning we got a GDP report. What we found out the morning after the Fed was the economy is slower than most people think and prices are still rising faster than most people think. So it wasn't news, it was just worse news in both directions. So where does that leave us? The 5-year, right when we sat down, when I sat here a week ago, it had just come off a trade at 320. And the day after the FOMC news, when the GDP report came out, it hit 265. So of 360 down to 273 has now been extended down to 265. That's not that big of a change, but we're still at the low end of the range. The market seemed to be focused only on economic weakness and not on the Fed tightening. Now think about last June, when the 5-year was at 360, the market was focused only on the Fed tightening and not on economic weakness. The reality lies somewhere in between. I had thought before we'd be in a trading range. I still think that. They pushed it a little bit on the downside because of the GDP report. But there's so much uncertainty as to what's going to happen. The Fed's insisting on continuing to raise rates to fight inflation. More and more people are insisting that there's going to be a recession. Recessions typically cause rates to go down. Inflation typically causes rates to go up. What you're probably left with is a market that for the next month or two could still be in a big trading range. Rates are low. It's good for mortgages. Mortgage rates are connected to Treasury rates. Right now they're going to be down. The spreads may change, but this is still a relatively low rate environment basis the last couple of months. It's a high rate environment basis the last couple of years. And it's a low rate environment if you want to look at it historically. Crude oil is kind of going sideways. Good news is maybe gas prices are way down. In our part of the country, regular gas is under $4 for the first time in a while. So the news is not all bad, but we're going to have to, the markets are going to have to agree on how to digest a combination of higher interest rates from the Fed and potentially damage to the economy. And I don't think that's going to come with a rally or a sell-off. I think it's going to come with a lot of volatility back and forth. And we're not really going to know about the economy and what the Fed does for several months as the Fed continues to raise rates and the economy continues to respond to that. Right now, we're probably looking at pretty much the low end of the range and a good time to take out a loan. You're probably not going to see much lower rates than this anytime soon, maybe down the road, but not for the next few months. In the meantime, tune into our YouTube channel, AD Mortgage, and for any kind of updates, and we'll continue to plod forward through these markets and see what we can come up with. Have a nice day. Thank you very much.